Okay, last question for you. Shout outs and call outs. Which SaaS company do you believe has best utilized alternative financing methods to achieve rapid growth while maintaining long-term stability?
You mean like in the universe of
Yeah,
SaaS
which one do
companies
you look
ever?
at and you say, gosh, they did it very smartly, and that would be a model to look at?
Yeah, it's a really, I wouldn't claim to be intimately familiar with like Mailchimp's capital structure.
Yeah.
Amazingly successful company, right? I think we all understand that. And they didn't raise, I'm trying to think if they raised any institutional venture round before they sold to Intuit. I can't remember if they took a growth round from someone
Wow.
like an
Hmm.
Excel who came,
Yeah.
I don't believe they did. And so, and I don't know if they ever borrowed any money. I really truly think they just truly bootstrapped it. They had an agency, a marketing agency. They ended up building a product, eating their own dog food, and not slow, that's not the right word, but call it 15 to 20 years to something very large. So
Yeah.
I'm like, hey, and that harkens back to my investment banking days. Now they had a much bigger outcome than any of the clients I worked with,
Right.
but like it wasn't overnight. They
Yeah.
took their time.
Yeah.
I'm sure they worked really hard and had their own pressure and objectives to grow the thing,
Yeah.
but they were able to do it on their own, in their
Yeah.
own way, and ultimately have a ton of success.
Well, I think we've seen broadly in the market this shift. People talk about growth at all costs to efficient growth. And one
Yeah.
of the things I tell people is you always want to be, in my opinion, look, I don't have a helicopter, I don't have a yacht. Take this with a grain of salt. But I do think this idea of having control over the business so that you can get profitable at any time. Because when
Mhm.
you're profitable, you're controlling your own fate. You're making your debt payments, and you're not obligated to do anything that isn't smart for the business. And so then you can invest more and go unprofitable for some period of time.
Right.
You're doing it deliberately, intentionally, and you know how to pull back. ServiceNow did this really well. I remember it was either their CEO or CFO who said, I can get profitable at any point. And the street was like, blah, blah, blah. And he did it. He just did it. And then all of a sudden their multiple went up like 30x or something. It was like the craziest thing in the world. But it was because he and the team, the broader team, had their hands around the business and they could say, we can go profitable when we need to, but now we're going to invest to continue to grow. And it's awesome.
That's great flexibility to be able to have. And I think for me, it's all about look, at the end of the day, this may not play well, but I think of the businesses that we work with as small businesses. In the
Yeah.
grand scheme of things, they are subscale, sub $15 million in revenue. That's not a very big company. Now, they may have certain dynamics that make them more compelling than any other small business out there in the world: margin profile, retention metrics, the true promise of subscription software,
Yeah.
assuming that is being delivered through good retention. That's been a four-letter word. That's literally a four-letter word and has been one in startup circles. The word small business is a four-letter small business. That's not exciting,
Yeah.
which has been put forth by venture capital. But I'm like, hey, look, you can have a very successful small business, or if you don't want to apply that moniker to it, let's call it something else. That's why we
Yeah.
intentionally say we work with established software companies.
Yeah.
They are established. It takes
Yeah.
a lot of work, learning, failure, sometimes
Yeah.
some capital to get to $5 million in revenue. It
Yeah.
just does.
And very few get there.
And
That's the other
very
thing.
few get
When you
there.
look at the Pareto chart in terms of how many companies actually get to those different wickets, that's what I show my company was like, look, we're in rare air in terms of where we are right now. And that just means it gets harder and harder. And so at each one of those, there's a fallout rate. So if you're still being successful, you still have control of the company and you're driving to profitability, like you're going
Yeah.
to keep being one of the breakouts.
And for me, it's basically, okay, you can be on that path. Maybe you're growing at 30, 50, 70%, don't know. You can hop onto a more aggressive growth path so you can do that. And then
Hmm.
you can hop back off of it.
Yep.
Maybe if you're just from day one on this super aggressive thing that's supposed to pan out, it can be really hard to hop off of that
Yeah.
path.
You get
Like you're
addicted to the growth.
probably
Yep.
not going to do that. You're probably just going to either really succeed or fail.
Yeah.
And
Yeah.
way, way more fail than really
Yeah.
succeed. And yeah,
With that, I think wrapping this up a little bit is just this idea of learning about capital structure, being deliberate about capital structure is incredibly strategic and something CEOs should spend time on.